Picture this scenario. You're sitting at your trading desk, watching your eighth consecutive trade hit its stop loss. Your carefully calculated 5-to-1 risk-reward setup just evaporated again. Meanwhile, your trading buddy, who targets simple 1-to-1 ratios, is quietly banking consistent profits, trade after trade, week after week. Something doesn't add up here, does it? Every trading educator on the planet preaches the gospel of wide risk-reward ratios. Risk 100 to make 500. Only need to win 20% of your trades to break even. The math sounds bulletproof, almost too good to be true. And here's the thing, it actually is too good to be true for most traders. Today we're going to shatter one of the most persistent myths in trading education. We're going to examine why chasing those impressive sounding 5-to-1 setups might be quietly sabotaging your account, while simpler 1-to-1 approaches are building consistent wealth. This isn't just about numbers on a spreadsheet. This is about what happens inside your head when you're facing your 10th loss in a row, wondering if your strategy is completely broken. By the end of this analysis, you'll understand exactly why professional trading firms don't obsess over wide risk-reward ratios the way retail traders do. You'll see the psychological traps that wide ratio systems create, and most importantly, you'll discover why the approach that sounds less impressive often delivers far superior results in the real world of trading. Let's start with something every trading course conveniently ignores: the brutal reality of losing streaks. Not just 1 or 2 losses, but those soul-crushing stretches where absolutely nothing works, where every single setup fails, where you start questioning whether the market has fundamentally changed, where you wonder if you should just quit trading altogether. Here's what the textbooks won't tell you. These losing streaks aren't rare anomalies that happen once in a blue moon. They're mathematical certainties that occur with predictable frequency based on your win rate. And the frequency of these psychological beatings changes dramatically depending on whether you're targeting 1-to-1 or 5-to-1 ratios. Consider 2 different traders using profitable systems. The first trader uses a 1-to-1 risk-reward approach with a 55% win rate. Nothing spectacular, just slightly better than a coin flip. The second trader hunts for those coveted 5-to-1 setups, achieving a 25% win rate, which is exactly what the math requires to break even. On paper, both systems can generate profits. The 5-to-1 trader might even show higher theoretical returns. But paper doesn't account for what happens inside your skull when you're executing these trades day after day, month after month. The 5-to-1 trader is losing 75% of the time. 3 out of every 4 trades end in failure. Think about what that feels like psychologically. You wake up each morning knowing that statistically, today's trade will probably lose. You place your order knowing that the odds are heavily stacked against this particular setup working out. Now imagine hitting a string of losses with a 25% win rate. Experiencing 8 or 10 consecutive losses isn't some black swan event. It's a normal Tuesday. The mathematics of probability virtually guarantee these extended losing streaks will happen multiple times per year. Meanwhile, the 1-to-1 trader wins 55% of the time. More wins than losses. Their losing streaks are shorter, less frequent, and far less psychologically devastating. They might hit 3 or 4 losses occasionally, but 8 or 10 in a row becomes extremely unlikely. This difference matters more than any mathematical edge on paper, because trading isn't just about math. It's about execution under pressure. It's about maintaining discipline when your account is bleeding. It's about staying rational when every instinct screams that something must be wrong with your approach. Research from behavioral finance shows that traders who experience extended losing streaks perform significantly worse on subsequent trades, not because their strategy changed, but because their psychology became compromised. The human brain interprets repeated losses as threats to survival, triggering stress responses that impair rational decision-making. Your nervous system doesn't care about expected value calculations when you're staring at your 7th consecutive loss. Ancient survival mechanisms kick in, flooding your system with stress hormones that make clear thinking nearly impossible. You start second-guessing every aspect of your approach, searching for problems that might not even exist. The 1-to-1 trader rarely falls into this psychological death spiral because wins come frequently enough to maintain confidence and emotional stability. Each victory reinforces trust in the system before doubt can take root and spread like a virus through their trading psychology. There's another critical factor that traditional trading education completely overlooks: the concept of trade frequency and learning acceleration. The 5-to-1 hunter waits patiently for those perfect setups that offer massive reward potential. These opportunities are rare because they require very specific market conditions: strong directional moves combined with tight consolidations that allow for distant profit targets while keeping stops relatively close. In a typical month, this selective approach might yield 8 to 12 high-quality opportunities. Each trade becomes precious because chances to express your edge are limited. The pressure on each individual trade intensifies because you know the next opportunity might be days or weeks away. Compare this to the one-to-one trader who finds viable setups everywhere. Any decent support or resistance level, any breakout with momentum, any pullback in an established trend. They're discovering 20 to 30 solid opportunities per month without compromising their standards or forcing marginal trades. This frequency advantage creates multiple benefits beyond just more chances to profit. Every trade provides valuable data about market conditions, strategy performance, and personal psychology. The high-frequency trader accumulates insights and experience at an accelerated pace, developing market intuition that can't be learned from books or simulations. Developing eulations, market-accelerated pace into or submission that can't be learned from books. This accelerated learning curve becomes particularly crucial when markets shift and evolve. The trader taking 30 trades per month notices changes in market behavior within weeks. They spot when their win rate drops from 55% to 48% and can investigate immediately. Maybe volatility has increased, maybe their entry criteria need adjustment for current conditions. The selective 5-to-1 trader might not even recognize these shifts until months have passed. By the time they've collected enough data to identify the change, market conditions could have shifted again entirely. They're always trading with outdated assumptions, always one step behind the market's evolution. Now let's examine something that will shock most retail traders. Professional trading firms don't actually obsess over wide risk-reward ratios the way YouTube educators suggest they should. Walk into any serious prop firm and you'll discover their internal training focuses on win rates, consistency, and psychological management far more than impressive-sounding risk-reward metrics. Jane Street, one of the world's most profitable trading operations, typically uses risk-reward ratios around 1-to-1 on most of their strategies. They're not swinging for home runs. They're grinding out small, consistent edges on enormous volume. Their success comes from execution excellence and superior market-making abilities, not from hunting unicorn setups that offer 5 times their risk. DRW Trading, another elite institution, emphasizes high probability setups with manageable risk profiles. They scale position sizes dynamically and focus relentlessly on execution quality rather than chasing wide ratios. These firms understand something that retail education misses entirely. Consistency trumps occasional brilliance every single time. The obsession with wide risk-reward ratios is almost exclusively a retail phenomenon. And it persists for one simple reason: it sounds incredibly sophisticated and professional. Telling someone you only take 5-to-1 setups makes you sound like a serious trader who knows advanced concepts. It's impressive cocktail party conversation. The reality is that impressive-sounding strategies and profitable strategies often have nothing in common. Professional traders think in terms of edge and execution, not rigid risk-reward formulas. They ask, what's the highest probability setup available right now? What's my actual advantage in these specific market conditions? How can I manage this position to maximize expected value over time? This flexible thinking allows them to adapt as conditions change. When markets are trending strongly, they might let winners run well beyond 1-to-1. When conditions are choppy and ranges are tight, they'll gladly bank 1-to-1 profits, rather than hoping for something that isn't realistic. Fixed risk-reward thinking creates mental rigidity that markets punish ruthlessly. You end up rejecting perfectly good trades because they only offer 1.5-to-1 potential. You hold positions too long, hoping they'll reach arbitrary targets that have no basis in current market structure. You optimize for ratios instead of optimizing for consistent profitability. Consider what happens during different market environments. In trending markets, both approaches can work well. The 1-to-1 trader captures consistent moves while the 5-to-1 hunter occasionally catches those massive breakouts that justify weeks of patience. But trending markets don't last forever. During choppy, range-bound conditions, the dynamics shift dramatically. The 5-to-1 trader struggles to find setups that offer sufficient reward potential within tight ranges. They either wait endlessly for clarity that never comes, or they force trades that don't truly offer 5-to-1 potential just to stay active. The 1-to-1 trader thrives in these conditions. Range trading becomes their specialty. Buy support, sell resistance, bank consistent profits, while their selective counterpart sits frustrated on the sidelines waiting for trends that aren't coming. Market conditions change constantly. Economic cycles shift. Volatility expands and contracts. Central bank policies evolve. The trader who adapts to these changes rather than forcing markets to fit their rigid criteria enjoys sustainable success across all environments. There's also the critical factor of capital efficiency to consider. The 5-to-1 hunter deploys capital sporadically, sometimes holding positions for weeks, while waiting for distant targets. Their money sits idle between setups, earning nothing while opportunities pass by. The 1-to-1 trader keeps capital active and productive. Faster trade turnover means more opportunities to compound gains. Money doesn't sit dormant waiting for perfect conditions that may never materialize. This velocity advantage compounds dramatically over time, often overwhelming any theoretical edge that wider ratios might provide. Professional money managers understand this principle intimately. They're measured on return on capital employed, not on individual trade risk-reward ratios. Keeping money active and generating consistent returns matters more than occasionally hitting spectacular individual trades, while capital sits unused for extended periods. While consistent individual active and generating keeping trades moneyed ratios. Hitting spectacular returns matters more than occasionally capital extended for sits unused periods. The trading education industry has built an empire selling dreams of 5-to-1 glory while ignoring the harsh realities of execution. They've convinced countless traders that wider ratios automatically mean better results, creating a generation of setup hunters who spend more time waiting than profiting. Here's the uncomfortable truth that no guru wants to admit. The best risk-reward ratio isn't the one with the highest theoretical return. It's the one you can actually execute consistently without psychological destruction. It's the approach that keeps you in the game long enough for your edge to compound into real wealth. Stop chasing impressive-sounding ratios that look great on paper but destroy accounts in practice. Start building systems around psychological sustainability and execution consistency. Test both approaches with your own data. Be brutally honest about your tolerance for losing streaks and drawdowns. The professionals already know this secret. They've abandoned the retail obsession with wide ratios in favor of approaches that actually work in live markets. They prioritize consistency over occasional brilliance, understanding that survival leads to prosperity while spectacular failures lead nowhere. Your goal isn't to impress other traders with sophisticated sounding strategies. Your goal is to extract consistent profits from markets while maintaining your sanity and capital. Sometimes the approach that sounds less exciting delivers far more excitement where it actually matters in your account balance. The choice is yours. Continue chasing the 5-to-1 fantasy, or start building real wealth with strategies that actually work for human beings, trading with real money in real markets.